Hello and welcome to the 47th weekly webinar. This is CRP speaking to you pre-recorded. This is a recording. Usually the webinars are live, but I'm on vacation. So webinars number 46, 47, and 48 have been pre-recorded. So the information I'm going to be giving you is based on data from February 10th. It's as you're listening to this, it ought to be February 21st. If any information I say is, out of sync with current reality, it's because I recorded 10 days before you're listening to it. So anyway, let's get to it. The weekly webinar today is called The Coming Crash, and I do believe that we are about to have an inflationary crash as opposed to a deflationary crash. Now, if you don't know these terms, don't worry. I'm going to explain them to you. They're very simple once you get a handle on it. You have to understand something about the financial world. For the most part, people in finance want to obscure what they are doing. They don't want neophytes, civilians, people who are not as plugged in as they are, to know exactly what's going on. They much prefer to act like high priests, and you're just part of the congregation and you don't know the secret rites. Most finance people are like that. And a lot of times they use language that is designed to intimidate. And so in this discussion about the coming economic crash, I'm going to try to make things as simple as possible. And so do keep in mind that this stuff is fundamentally simple, and you have to think of it mechanistically. That is, that everything is connected. And so when you move one lever, something else happens. So you have to think of the whole financial machine as just a series of gears, that they're all connected. When one thing happens to one gear, something else happens somewhere else in the system. But it's fundamentally simple. It's fundamentally understandable. Okay? I want to preface this discussion with that before I get going. The other thing, too, is that the economic analysis that I'm going to be presenting is based on the American economy. The American economy is currently the largest in the world, and it will remain the largest in the world for quite some time. It dominates global trade and the global economy. So it pays to pay attention to the American economy. Some of the things I'm going to be discussing don't really fit in with the European Union or China or Japan or any of the other secondary economies and tertiary economies. They are particular to the United States, which has a very unique role because it has the reserve currency. I'll be discussing that in a bit, what that represents and what it actually means, right? But you have to understand that it's not merely that the United States is the biggest economy in the world that matters. It's also that it has the reserve currency, that is the currency that the rest of the world uses for trade, okay? It's very important that you understand that. Now, let's get going. So, what is a crash? Because I'm going to be talking about a crash, and it's important to know what is it? Well, you have to define your terms. That's something that I learned in Philosophy 101, and here I'm not going to make the exception. A crash is when asset prices are overvalued relative to commodities and consumables, or as relative to the asset's own revenue, to a degree that it is not sustainable in the long term. That's the key issue. It's not sustainable, okay? The valuation of the asset, it's so overpriced that there is going to come a moment when that asset price is going to collapse. That's a crash. And we talk about crashes all the time, the stock market crash. What does that mean? Oh, the Dow Jones fell 20% today. Oh my God. Well, that was a crash. That's when the stocks, the average price of the stock, of course, that's what a stock market index is. It's an average of all the stock in that index. It falls. It falls drastically in a short period of time. That's a crash, okay? Now, it seems very clear that there will be a crash. Are we close to a crash? Yes. How do we know we're close to a crash? Well, we have several indications. Number one, assets are severely overvalued relative to their income. Okay, now what does that mean? See, an asset, like say a stock in a company, when you add up all the stocks in the company, all the equity in the company, that's 100% ownership of the company, right? That's the whole point of it. So if the total valuation of that company is, say, arbitrarily, I'm just making up numbers, say $1 billion. The price of the shares, if you added up all the shares, it adds up to $1 billion. That's the price of the company. But it's only generating revenue. That is, excuse me, not revenue, income. Income of, say, just, I'm just blue skying here. Say $2 million a year. And you say, well, $2 million a year of income, that's quite a bit of money, right? Well, not really, not if it's valued at $1 billion. $1 billion is 500 times 2 million. And so you would say that that company is overvalued because its price, $1 billion, is 500 times its yearly income. That's absurd valuation. That's overvaluation. Now, suppose a company has $2 million net income per year. Now, a reasonable valuation of that company would be something between 15 times those yearly earnings, and on the outside, maybe 30, 35 times those yearly earnings. So, $2 million earnings by, say, 35 times, that would be $70 million. That would be a reasonable price for a company that has net income of $2 million per year. But $1 billion, that's overvalued. That's absurd. You see? So many companies today are severely overvalued, and some of them far more than the 500 times ratio that I just described in this hypothetical. Okay? And so these overvalued assets, it makes people nervous because they know that these prices for these assets are not sustainable. It's like musical chairs. See, you ever played the game of musical chairs? You're playing with your little friends there. You probably played it at some birthday party when you were like 10 years old or something like that. And there are, say, 7 chairs, but 8 children are playing, and the music is playing. But when the music stops, all the children have to find a place to sit, and there's going to be one child who's left out, and that's the loser of the game, right? Well, in this game of musical chairs, it's all of the investors in the world are running around as the music plays, and there are only, a dozen chairs, even though there are millions of players. You see the problem? See? They're all going to freak out because none of them are going to have a chair when the music stops, okay? So assets are severely overvalued. That's the first indicator that we're close to a crash. Second, and it's more subtle, is that there's an income inequality and a wealth inequality among people, among the population. That's at an all-time high. This is the difference between the haves and the have-nots is at historic highs in the United States. Nothing comes close to this wealth inequality. It's catastrophic, and we're seeing it with so much of the woke culture bullshit, okay? The woke culture bullshit is bullshit, but it is indicative of people who are resentful of the fact that they are part of the have-nots. The wokesters would not be getting so many adherents if there weren't a lot of people who are very bitter, very resentful over the fact that they don't have anything. And there are these billionaires who have it all. I mean, they have the whole enchilada. And it drives a lot of people nuts. It drives me nuts. And I'm not a wokester. And so, yeah. And on top of that, like in my own situation, I'm fairly well off, thank goodness, knock on wood. But even so, I'm extremely resentful at this wealth inequality. Imagine somebody, perhaps you, who are having a hard time putting food on the table, paying your rent. Huh? I mean, how resentful is that person going to be? Yeah. And so income inequality, wealth inequality, those are at all-time highs, and that's usually a bad sign that a crash is coming. There are also subtle signs. There are these widespread speculative manias. We saw that in GameStop recently. These speculative manias, they tend to happen when you're coming close to a crash. There are also a whole bunch of ignoramuses talking about the markets as if they know what the fuck they're talking about. That's also very indicative of a crash. There's a famous story of Joseph P. Kennedy Joe Kennedy was the father of John and Robert Kennedy, of course, and he was a famous investor, a very shrewd investor. And he skated away from the 1929 crash scot-free. Nothing happened to him. And he always explained what happened. What happened was that in 1929, before the crash, he was getting his shoes shined. And the shoe shine boy was giving him stock advice, was telling him what stocks to buy and what was on the rise and what not. And the shoe shine boy was telling him that he was fully invested in shit like that. And that's when he knew, Joe Kennedy would say, and he told this story many times, and it's a true story. That's when he knew that he had to get out of the market, and he got out of the market. And when the market crashed in October of 1929, nothing happened to Joe Kennedy. He was on the sidelines watching as the market just completely cratered because he knew. When ignoramuses are talking about the market, when the shoe shine boy is giving you stock tips, you know it's time to exit. When there are speculative manias, you know that it's a bad, bad sign. Now, there are two kinds of crashes, okay? Now, what I'm telling you here is not the economic orthodoxy. A lot of economists might disagree with what I'm about to say, but the logic behind it is sound, and so they might disagree of how I characterize it, but they're not going to really be able to disagree with the logic by which I've made this distinction between deflationary crashes and inflationary crashes. Now, a deflationary crash is when the asset price, be it a stock, a bond, a piece of land, gold, whatever, the asset price falls in price. It falls in price from, say, let's just say for the sake of argument, it was selling yesterday at 100 and now it's selling at 80. Okay, and tomorrow all of a sudden it's selling at 60. That's a deflationary crash. Deflation, that is, the loss of inflation. It's going down. The price is going down. Okay. When a stock market falls, when a bond market falls, that's a deflationary crash. I'm talking when it falls abruptly. 20% in a day. Or more than 5% on several consecutive days. That's a deflationary crash, okay? When housing prices fell in 2008, that was a deflationary crash. Now, the housing price collapse of 2008 is very important that you keep in mind. For those of you who don't know what happened or are not clear on the details, the general story is that a lot of people went into a lot of debt to buy houses. Regular people, and a lot of these regular people did not have the credit worthiness to buy these properties. And so because of all this influx of buyers, the price of properties went way up. And there were a lot of debt instruments that were based on these mortgages. What would happen was that, say, a lot of mortgages that were similar, similar types of houses at similar interest rates, they'd be bundled together and sold as securities. And these securities were called mortgage-backed securities. They were traded like bonds because they were bonds. They were debt instruments. Basically, all of these mortgages were bundled up by the thousands and sold to investors. And so what happened was that there was a housing bubble in the early 2000s that finally popped in 2007 and 2008. And because it popped, because all these prices of these houses started to fall nominally, i.e. the price that they were listed for started to fall, what happened was that a lot of these debt instruments, these bonds, became worthless. And because of this, because these bonds became worthless, it triggered a financial crisis. The banking system in the United States, and frankly the whole world, came inches from going bankrupt. Because all of these houses, as they went down in value, by going down in value, it triggered mechanisms in the bonds that basically said that, these bonds were no longer investment grade. And so these bonds had to be sold by these banks. And all of a sudden, all of these banks had to sell more or less the same types of bonds, and they tried to sell them out into the open market, and there were no buyers. And so all of a sudden, you have all of these bonds that are at the market that are trying to be sold, and they're priced at, say $100 each. But there are no buyers at 100. There are no buyers at 90 or 80 or 70 or 60 even. There are no buyers, full stop, because everybody's a seller, because everybody wants to get out of this thing. And that's a deflationary crash. That's when all the prices go down. And as you can see, it has a domino effect, because when one asset class goes down, other asset classes that are allied or dependent on that initial asset, they also go down. The price of houses went down because there was an economic slowdown. A lot of people lost their jobs. Because they lost their jobs, they weren't able to pay their mortgages. And because they weren't able to pay their mortgages, those houses went into foreclosure. The houses went into foreclosure, and therefore the banks had the ownership of these properties and tried to sell them, but there were no buyers, and so they lowered the prices, lowered them more and more, and therefore these mortgage-backed securities started going down in value, and all of a sudden these banks that had quoted the price of these mortgage-backed securities on their books as $100, they found that they couldn't sell them for even $60, and this would mean that technically a lot of these banks were all of a sudden bankrupt. Yeah. That's basically what happened. That's a deflationary crash. And the deflationary crash of 2008 scared the ever-living shit out of every living financial authority that is working today and is in a position of power. All of the people, Jerome Powell, who's the chairman of the Federal Reserve Board, Janet Yellen, who was a member of the Federal Reserve Board, she eventually did become chairman and is now the Treasury Secretary of the Biden administration. All of these people, they were scared shitless because they saw how the whole house of cards almost collapsed in 2008. And so there's a saying that every general fights his last war. It's very true. And so all of the people who are in power now are terrified of a deflationary crash, that is, where the prices fall and create a cascading effect that could potentially lead to widespread bankruptcies. They are terrified of this. Now, what is an inflationary crash? Because I talk about a deflationary crash, but now it's an inflationary crash. An inflationary crash is when asset prices remain stable-ish. Okay, they're more or less stable, but consumables and commodities rise in price dramatically. It's sort of like, you own a home and you have a car, right? And, it costs you, just say, $2,000 a month, the mortgage, right? And you have a nice enough house. And, your living expenses, food and gasoline to get to your job cost you, just again, for the sake of argument, costs you another $2,000, right? For you and your family. But then all of a sudden, the mortgage stays the same, the price of your house stays the same, but all of a sudden your consumables, food, gasoline, they rise. And now you're paying $2,500 instead of $2,000 like before. What do you have there? Well, all of a sudden you have 25% inflation. Yeah, because 500 is 25% of 2,000. Before it was 2,000, now it's 2,500. That's 25% rise in your living expenses. That's 25% inflation. You see? But did it affect the price of your house? No, it did not. See? That's an inflationary crash. That's when the consumables start to rise in price. Sometimes they rise dramatically. And I'm going to explain in a little while because it gets complicated kind of quickly. So I need you to slowly follow me along, because a lot of you guys who might be more sophisticated and understand things better will say, but hang on, the house is not going to maintain the same price. It's actually going to change. Yes, it will. But let me just get through this step by step so that you see where I'm going with this argument. Okay, it's important that you understand every step. And those of you who are more sophisticated, you're just going to have to bear with me. Okay, so the U.S. government, the authorities in the financial sector, I'm talking both the people in the government, in the Federal Reserve, I'm talking also people in the big banks and the big hedge funds, they all are terrified of a deflationary crash. And the way they got out of the 2008 deflationary crash was essentially they printed money so as to prop up asset prices. That's what they did. See, there were these programs called quantitative easing. They went through a whole host of them called quantitative easing, then quantitative easing 2. There was SNAP, I think, or START. They went through a laundry list of different names for these different programs, but they were all basically the same. The Federal Reserve basically created money out of thin air. They just hit a button, and all of a sudden, in an account that they had that had zero, all of a sudden they had 100 billion bucks, 100 billion with a B bucks. And they took that 100 billion bucks that had just magicked onto their computer, and they went out and they bought bonds. They bought treasury bonds, they bought mortgage-backed securities, they bought investment-grade bonds, they bought all of these debt instruments so that their price wouldn't fall, to prop up the price of these assets. And that translated into this stock market that has been going up and up and up and up since 2008. It's all been by way of printing money. That's how they did it. I'm grossly simplifying, of course, but that's essentially what happened. They printed money to prop up all these asset prices. What are those asset prices I'm talking about? I'm talking about stocks and bonds. Because, as I explained before, if a bank has on its books some bonds and the bonds fall drastically in price, that's a loss for the bank. You see? And so the bank can't afford it. The bank has to get rid of these bonds. And if it tries to get rid of these bonds, and all the banks try to get rid of these bonds at the same time, they will sell into an empty market. So instead of selling it for $100, which is the nominal value of the bond, they'll sell it for 60. So the Federal Reserve stepped in and became the buyer of last resort. That was the rationale. They would be the buyer of last resort for all of these bonds that everybody claimed were perfectly fine, perfectly safe, but just market conditions were such that they needed some help propping up the price. And the Federal Reserve stepped in and bought these bonds. Okay? Now, you can argue whether these bonds were solid or not. That's not important. The point is, this is what they did. Okay? The way I'm describing it to you is simplistic in certain ways, but it's basically what they did. And you talk to any economist and he'll start, saying, oh, there was a valuation and this and that and all kinds of different parameters as to which bonds were purchased and which were not and blah, blah, blah. But at the end, beyond all the bullshit, that's what they did. They printed money to prop up these markets. Okay? Now, they've been doing this since 2008. They never got off the juice of the printed money, of the fake money, okay? They just kept on printing and printing. And every time they would say, well, we're going to stop or taper down. But whenever they started to taper down, there'd be what was known as a taper tantrum. The markets would sort of like say, what, you're going to stop? You're going to stop? Don't stop. We're getting all this sugar. It's so yummy. Don't stop. And the markets would start to fall, and it would freak out the Federal Reserve, and so they'd give more candy to the kid. I mean, really, it's just like a parent and a child. And the parent didn't have the discipline or the confidence to say, no more candy for you, kid. You're blimping out. They didn't have the self-confidence. And so for 12, going on 13 years now, they've been feeding the kid sugar, i.e. printing this money. And the markets have come to all depend on this printed money. And that's why all of these stocks, all of these bonds, they are so overvalued. That's why you have a company that has a market capitalization of $1 billion on net income of $5 million. It's absurd. It's crazy. But it's because of what the Fed did, and more to the point, it's not so much what the Fed did in 2008. You could argue that it was justified. I would think it was actually justified at the time to stave off an impending collapse of the whole financial system. Sure. The problem is that they didn't stop. They kept on feeding candy to the kid. They kept on giving free money into the market for 13 goddamn years. So, of course, they created a bubble. And this bubble is about to pop. And the signs are everywhere. Now, why is it going to pop now? Well, to tell you the truth, it kind of did pop in March of 2020 with COVID. It popped kind of badly. And it freaked the fuck out of everybody. Because, see, everybody says that the markets tanked in March of 2020. You should go and check out the chart for March of 2020. I actually should have had it here on my slides, but whatever. You see, you check out the market dip in March of 2020. And, that dip was not because of COVID. It was because everybody knew that the music had stopped and they wanted to get a seat as quick as they could. The Federal Reserve just went on a huge money printing binge in March of 2020 to quote unquote support the markets in face of this unprecedented pandemic. But see, it wasn't the pandemic. The crash of March 2020 was because of the 13 years of money printing, the 13 years of overvaluation of assets, of everybody knowing that the shit that they are buying is not worth the price that they are paying. It's not worth $1 billion. At most, at best, it's maybe worth $70 million. They knew it. But what happened was that when all of a sudden everybody started selling and the markets just tanked in March of 2020, the Fed stepped in and started buying and buying because they just created all this money. And by buying all these assets, they propped up the prices. And the markets, what did they do? They shot the moon. They went up and up and up and up and up. It's all a sugar high. It's not real. Because during the lockdowns, during the past year that we've been in this stupid pandemic, these companies that have this incredibly overhyped valuation, well, all of these companies, they're not bringing in the income. It doesn't make any sense. Their valuations make no sense. Tesla is the perfect example. The overvaluation of Tesla. Tesla right now, as I'm recording this, is worth more than the top 10 automakers on the planet combined. That's like Honda, General Motors, Ford, Volkswagen, Fiat combined. That doesn't make any fucking sense. That's crazy. That is just nonsensical. It is because Tesla is a fine company and makes a great product and all the rest of it. I'm not shitting on the company. But that company, in terms of how much it sells and how much it earns per car, and the size of the market into the future, it's insane the valuation that it has. It makes no sense unless you realize it's speculative. It's all speculation. And that's just a sign of a bubble that's inches from popping, okay? There's the overvaluation of Tesla. There's the overvaluation of Bitcoin. Bitcoin is what, like $40,000 per Bitcoin? That's insane. That's speculative. That's a mania. And there are other assets that are absurd because they're based on zero fundamentals. Now, some of you guys are into cryptocurrencies. Cryptocurrencies are bullshit. And I don't care if you don't like it. I don't care if you decide that you're not going to follow me on Patreon anymore because I point out the fact that crypto is bullshit. It is speculative. It doesn't make any sense. Why doesn't it make any sense? Because there's no need for cryptocurrency. There isn't anything that you absolutely positively need to buy that you can only buy with cryptocurrencies, be it Bitcoin or any other. You see, in the world market, you need dollars to buy oil. And I'll get to that in a minute, but it's very important that you understand. See, oil producers do not sell oil for anything other than dollars. Yeah, there are a few markets here and there, but they're in peripheral. The big ones, OPEC and the United States, which are the major producers of oil on the planet, they do not sell oil for any other currency except dollars. You need dollars to buy oil. Therefore, if you're in Japan, for instance, and you have a humming along economy, no problem, right? But you need to buy oil, right? So what do you have to do? You have to go out into the market, buy dollars first with your yen, find somebody who wants your yen and is willing to exchange your yen for their dollars, and take those dollars and buy oil. That's how Japan buys oil. Japan needs dollars. Every country on the planet needs dollars because the major oil producers sell only in dollars. Saudi Arabia, Kuwait, and it's because of strategic partnerships that the United States has put into place back in 1974, as a matter of fact. But that's not important for this conversation. The important thing is that, see, you have to understand that people need the dollar to buy certain things that they must get, such as oil. But you do not need a cryptocurrency to buy anything essential. Ergo, it's tulips. And those guys who have made a shit ton of money on Bitcoin and cryptocurrencies, good on them. But it just adds to the point that, see, we are closer and closer to a bubble because something that is fundamentally uh, um, arbitrary, like Bitcoin, like Tesla, that they're shooting the moon, that proves that this is just a bubble. It's a bubble that's going to pop because they all pop. When it pops, I don't know, but they all pop. It's like, I don't know when it's going to rain, yeah, but it's going to rain. Yeah. And you're like saying, oh, you can't tell me when it's going to rain. So you're wrong that it's going to rain. Ha, ha, ha. That's bullshit, right? I mean, if somebody says that to you, what do you say? You say, you're a fucking idiot. Okay. Guys who say that, oh, no, this will keep on going forever and ever. It's like guys saying, no, it's never going to rain. It's never, ever going to rain because right now it's blue skies. I don't see a cloud anywhere. So it's never going to rain. Dude, it'll rain inevitably. The market is going to pop inevitably. So anyway, you have overvaluation of certain things like Tesla and Bitcoin and other assets that are absurd. You have houses, for instance, in a lot of markets, little, shoebox houses, 1,500 square feet. That's roughly 150 square meters. And they're selling for over $1 million. What the fuck is that all about, huh? Yeah, that's crazy. Absurd valuation for assets. That's a typical sign that you're in a bubble. And speculative manias like GameStop was a lot of fun. It was a lot of fun to see these hedge funds get it in the ass, right? But that kind of speculative mania, that's a sure sign that you're coming up on the end of a bubble. It's a sure sign. Why? Because it's happened in every other bubble in the past, in every country in the world where there's ever been a bubble for centuries, okay? This is not new. This is not like novel. This is not like, oh my God, I've never seen this before. No, we've seen this movie tons of times, okay? It's like those stagings of Shakespeare's plays like Hamlet. Sometimes in the past they staged it with clothes of the 19th century and sometimes of the 20th century, and sometimes they dressed them up as Nazis and sometimes they dressed them up as, whatever the fuck. Different clothes, different settings, different sets, different actors, but it's always the same play, always the same story, okay? GameStop, that was a fucking clue, okay? Meanwhile, and because of COVID-19, revenues are collapsing. Now, this is a really bad sign, okay? Corporate income has fallen off a cliff because of COVID-19, obviously, because people are hunkering down, they're locked down. There are some information workers who can work from home, but a lot of workers, middle-class workers and lower middle class and lower class workers, they don't have a job. They're getting broker. And once you don't have a job, do you start spending? No, you don't spend. You don't go into debt to buy shit. And so what happens? A lot of corporations are going bankrupt, right? I was reading up today on LATAM, which is the largest Latin American airline, an airline from Chile, I'm proud to say. And they filed for Chapter 11. Yeah, because they have all the planes and shit, but they don't have any passengers because nobody's flying. See, all these companies, their revenues have fallen off a cliff because of COVID-19. That's one thing that's going on. And on the other thing that's happening, real estate rental markets are collapsing, especially in office and retail spaces. Because in the office space, what's happened is that nobody's going to the office because they're working from home. And a lot of companies are discovering that when they have people working from home, they work more productively. And also the companies are realizing that if somebody's working from home, they have basically shoved off onto their worker the cost of the office. See? Because they're not paying for the worker's office because they're working from home. See? So the company can save that money and put it, in their pocket. Okay? And so a lot of real estate office buildings, right? They are losing their corporate customers. Like in San Francisco, in downtown San Francisco, the office buildings there are barely at what you call it, not quite 60%, a little under. Okay, the vacancy rate is over 40% in downtown San Francisco. Yeah, that's a true fact. In downtown San Francisco, I mean, the epicenter of the tech of Silicon Valley and all that shit. 40% vacancy in the office buildings downtown. The Facebook building, empty. Everybody's working from home at Facebook because they can. And Facebook and the other tech companies are realizing that they don't need these really expensive offices. And insofar as retail spaces, well, all these retail spaces, there are no people walking around, and therefore, why have a retail space? You're going to go broke. The restaurants are all going broke. All the stores are going broke and shutting down. So real estate rental markets are collapsing. That is, revenue is collapsing. But the price of the asset is going up and up and up. Remember that hypothetical company I mentioned before that had $1 billion valuation and only a $5 million income? Well, that company, its valuation is going up as we speak from $1 billion to $1,100,000,000. And its income has gone down from $5 million per year to only $3 million per year. See? You see how the revenue and the market capitalization are getting wider and wider, that gap between them. That gap cannot get that wide. There comes a moment, a come to Jesus moment, a moment when everybody becomes like, whoa, 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 Nelly, let's wake up from this fever dream and realize what the fuck is going on. I'm holding on to the stock on this company, and the company is supposed to be worth $1 billion. Oh, now it went up. Now it's supposed to be worth $1,100,000,000, but its revenue is falling. Do I really want to be owning this company? Do I really want to hold on to this stock? And the music might stop at any minute, and this stock that right now it's at 1.1 billion, it might collapse to its real value, which is 70 million if you're lucky, i.e., a 95% loss. Do I really want to hold on to a stock that might drop 95%, or do I want to sell it? You see? You see how it works? The guy who's owning that share in that company that's worth 1.1 billion with crap revenue, no revenue, okay? Because there are no customers, because the whole fucking economy is closed down because of COVID. What the fuck you think that guy is going to say? He's going to say, I'm going to get the fuck out of Dodge. I'm going to sell this fucking thing because I made some money, yeah, but I don't want to lose 95% of my money, you know? I don't want that to happen, so he sells. And he sells, and the guy next to him sees him sell and says, fuck it, I'm going to sell too. And then it's a stampede. And then everybody is running for the door. Everybody's trying to grab a chair at this game of musical chairs because all of a sudden everybody realized the music fucking stopped. Okay? We are inches from that. Like I said, I don't know when this will happen, but I don't know when it's going to rain either. But I know it's going to happen. You see? Okay. So, next slide. What do the financial authorities want? Okay? It's very important to understand the motivation of people, especially people in power. Children are exceptionally good at studying their parents and knowing the motivations of their parents, because children depend on their parents for everything, for food, shelter, clothing, warmth, cuddles, all the rest of it. So children are very astute. They study the parent. You should study the financial authorities and not curse them, not say, oh, these people are bastards, they're assholes, they're this, that, the other. Of course, they're all those things. Yeah, I'm not going to argue that. But what I am going to argue is that, you bitching and moaning about them and how so awful they are and blah, 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 doesn't change the fact that they control your destiny, just like a parent controls the destiny of a child. And so it pays you to study the person who owns you, who controls your financial destiny. I mean, you might find it unpleasant to realize this, but you got to face reality and try to, get some advantage out of the situation wherever you can. Okay? Okay, so what do the financial authorities want? Well, they want to devalue the dollar. They'd love to be able to just decree that the dollar is devalued. Now, why would they want to devalue the dollar? Because see, if they devalue the dollar nominally, okay, the prices stay the same of everything. And that avoids all kinds of problems, see? Because see, if you have a deflationary crash where prices go down, right? Then what happens is that all the mess that I mentioned before that gets triggered. Banks have to sell shit. A bank can potentially find itself on the brink of bankruptcy or go bankrupt because the assets it holds are no longer worth as much as they thought that they were, and they have to sell them in order to get the cash, right? But if you devalue the currency, well, nominally, i.e., on the money, the number printed stays the same, but the value drops. If I devalue a currency by 25%, okay, let's just say that I can magically do this. Okay, it's not important in the mechanics; it's just a hypothetical. Suppose I could devalue the dollar by 25%. I just, turn a knob and it devalues by 25%. What would that happen? What would happen there? What would happen is that, see, all of these bonds, all of this debt, all of these stocks, they would maintain the same price. But what would happen is that all of the consumables and commodities would rise in price. They'd rise in price, and that would create price inflation. All prices of things would go up, especially of consumables, right? But the asset valuations would stay the same roughly. They wouldn't drop. And so because of this, see, these companies, instead of having revenues of, like in the hypothetical I was saying, that my XYZ corporation that had like 1.1 billion in valuation and only 3 million in yearly revenue, well, prices for its products would rise, and so all of a sudden it would have a lot more revenue. It would have, like, say, 4 or 5 or maybe even $6 or $7 million in revenue, okay? Because the rise in price, because I devalued the currency, and by devaluing the currency, those things that have objective value, such as commodities, they would rise against my now devalued dollar. And because everything that you consume, be it food, gasoline, whatever, energy, it's based on a commodity, on an objective thing, okay? Since that objective thing would go up in price, so you'd be paying more, but the money that you would pay, the extra money, that would mean, in nominal terms, more value for the company, more earnings for the company. And so it would prevent the companies from going bankrupt, and it would bring closer the valuation of the company to its earnings. It would lower that price to earnings ratio. You see? And that's what the financial authorities would love to be able to do, but they can't, because the dollar is the reserve currency. Now, what does that mean? The dollar is a reserve currency. It's the top dog currency, to make it simple. Okay? There is no currency above it. It is the currency of international trade because it controls the oil market. The oil market is the foundation, the pillar of American economic hegemony, global economic hegemony. It's because every country in the world needs dollars in order to buy oil. And therefore, the dollar cannot be devalued in a traditional manner. Because you see, in the past, for instance, suppose the Spanish, right, back when they had the peseta before the euro, see, they got into like the same fucking situation that the United States is in. Over indebted, too much debt, too much valuation of shit. They'd printed a bunch of money, right? So what did they do? They'd simply devalue the peseta. They'd say, suppose that on Monday the dollar is worth, say, 5 pesetas. I'm just hypothetical. And the dollar, 5 pesetas gets you $1. And of course, you need dollars to buy oil. Spain needs to buy oil on the global market. So it needs dollars, right? So it's 5 pesetas get you $1. And so suppose that they devalue the currency by, say, 40%. So all of a sudden, you need 7 pesetas to buy $1. They devalued the currency. They just said it. They just said, that's the new exchange rate, okay? And all of a sudden what happens at home in Spain is that all the prices for a whole bunch of goods and services go up because a lot of these goods and services depend on oil, depend on either directly on oil, such as gasoline for cars, or indirectly, such as food. They all go up in price. Food depends on the price of gasoline, of course, because you need to transport the food from the farm to the supermarket. And so, the cost of living for every Spaniard goes up by 40% because all these daily expenses that they have, they go up because the Spanish government devalued the peseta. But see, in Spain, in this situation back in the 1980s, say, this was possible because the peseta is not the reserve currency. It's not the big kahuna. The dollar is the big kahuna. So how do you devalue the reserve currency? Well, you have to basically do it by way of controlled inflation. Now, financial authorities know that asset prices are far too high relative to earnings, but they need for them to remain high and even marginally increase in price. Okay? Why do they need it? Because they want to avoid the domino effect that happened in 2008. Because if asset prices were to suddenly fall in a deflationary crash, like what happened in 2008, this would trigger collateral requirements that would not be met. They could not be met. And this would lead to mass bankruptcies of the financial system. Large banks, large companies, it would be chaos. It would be a repeat of what almost happened in 2008, only on steroids. It would be like magnitudes bigger because there's a shit ton more debt. And the economy today is far more fragile because of COVID than it was in 2008, 2007, 2008. Okay? So that's one reason that the financial authorities, the Federal Reserve and the Treasury Department, they have to keep prices of the assets stable. They can't let them fall. Okay? Also, there are a lot of pension funds and derivative assets that depend on high prices of stocks and bonds and real estate to fund their obligations and liabilities. A lot of these pension funds, for instance, that are paying pensions to all these retired workers and whatnot, see, if these assets start falling in price, they were not going to be able to pay their obligations. See? It's not that they're going to pay them in a devalued currency. They're simply not going to be able to pay them, full stop. And you're going to have old people who are not going to have money to eat, okay? You're going to have all kinds of mayhem and chaos, okay? Social chaos. Okay, so they can't allow asset prices to fall. So they want inflation to rise so that it effectively washes away the over-indebtedness of the system. Because when you have inflation, your debt payment goes down. Think of it like this. Suppose you own a gas station, okay? Now, you have, you took on a lot of debt to build this gas station, right? And suppose that, you're selling gas, let's do it simpler and quicker and more to the point. Your profit from gasoline is, say, 25 cents per gallon that you sell, okay? That's your profit, right? Now, if the currency inflates, okay, what'll happen is that you get more money, right? But what does that mean for your debts? Well, your debts become smaller, you see? Because if you devalue the currency by way of inflation, forget about the gas station example, I'll use it later. But if you have debts, say $100,000 worth of debt, and the currency is devalued, either directly, like the Spanish example with the peseta, or indirectly by way of inflation, that debt becomes smaller. See? If you have inflation of, say, 20%, I'm just making up a number, and you have $100,000 worth of debt, well, with a 20% inflation, that means that your debt is really down to $80,000. Nominally, it still says $100,000 that you owe, but as a practical matter, it's a quarter. It's 4/5 of what it used to be if there's 20% inflation. See, it goes down in real terms. You see, And this matters quite a bit if you have income in real terms. In the gas station example, see, he's selling gasoline. A guy who sells gasoline, okay, that's a real commodity, okay? It's inflexible in that regard. And therefore, his income would rise if he's selling gasoline and they devalue the currency. And since his income would rise because of it, his debt would become smaller relative to his income. That's the whole game plan of these guys. They want to inflate away all this debt so that nominal incomes rise. And this nominal income makes it possible to cut through all of this debt overhang, all of this debt that has been accumulated in the federal government, at the state level, in corporations, both investment grade and lower tier and junk bonds and all this debt. They want to get rid of this debt. That's the whole point. The Federal Reserve is realizing that all of this debt is just a time bomb, and that if they let it explode in a deflationary crash, it'll destroy the whole fucking system. So they figure that if they can inflate away the problem, they can diffuse this bomb. That's what they're counting on, okay? I mean, you have to understand their mentality. Inflation would mean that consumables and commodities rise in price, and it would be paid for by the middle classes and the lower classes and the lower upper classes, okay? Yeah, by regular people, by you, see? And at the end, the rich people would skate away. They might not be as rich as they were before, but they're not going to pay for this shit. You are. Inflation always hits the working people. Because what happens is that, see, when inflation hits and prices go up, you go to your employer and you say, hey, pay me more money. And the employer is going to say, no, I'm not going to pay you more money. If you don't like it, you can leave. And you're not going to leave. Because in such a situation, right, the economy is weak, there aren't going to be a lot of job opportunities. So you're going to continue with your shitty salary while food prices and gasoline prices and all the other consumables prices, energy, heating, electricity, they all go up. You get fucked. Inflation is a nasty, nasty business, okay? I know quite a bit of it because I remember very clearly the 70s and 80s in the United States. And my dad would explain it to me in some detail that I got a real clear sense of what the fuck was going on. And also because in Chile in 1970 to 73, there was hyperinflation. And the stories I heard growing up about that hyperinflation, they've stayed with me for the rest of my life. They're pretty hairy, okay? Inflation hits the people. It hits them bad. But it keeps the whole edifice from collapsing, okay? So the financial authorities, rather than let the whole financial system fail and just sweep it up and start over again, they're going to keep the whole corrupt fucking system and make you pay for it by way of inflation. That's their game plan. Yeah. You see? That's how they're going to do it. That's how they are doing it, as a matter of fact. The authorities know, however, that inflation can get away from them because it can. Because it's once inflation monster gets unleashed, it's very, very dangerous. It's always gotten away from countries that have unleashed inflation. Always. Venezuela, Zimbabwe, Chile, Argentina. I mean, fuck it. Every fucking country on the planet that has ever gone through a hard inflation spike, they always live to regret it because it always gets away from them. Okay? But going back to the American case. See, the authorities know that inflation can get away from them. So that's why the stimulus checks, student debt forgiveness, the $15 minimum wage, and all these other free market schemes, they're not being implemented by the Biden administration. No siree. Because the people in charge, the financial authorities know that if all this free money is put into the pockets of regular people, what the fuck you think they're going to do? They're going to go out and take this free money, this new money, and they're going to go and spend it. And what happens when everybody goes out to spend money at the same time? When everybody has more money, but there are the same number of goods, well, those goods rise in price now, don't they? And they rise in price precipitously. And so do you think that they're going to let that happen? No, come on, okay? Because they want this inflation to be stealth. They want it to be little by little, okay? They don't want it to be noticeable. I mean, a lot of people are noticing it, and I'll get to that in just a minute, but they don't want it to be a surge, because if everybody all of a sudden gets this huge $2,000 check, and perhaps the retards like fucking Andrew Wang or Chang or whatever the fuck his name is decide, oh yeah, I mean, UBI for all, $2,000 checks every month. Dude, if the whole American population got $2,000 checks every fucking month, the dollar would become worthless in about 6 months. I mean, worthless. I'm talking toilet paper, Weimar Republic, worthless. Okay? I mean, it would be a fucking disaster. Because, yeah, if everybody all of a sudden gets $2,000 every fucking month, what the fuck you think they're going to do? They're going to go out and buy shit. And so what would happen? They'd go out and buy Apple EarPods or Nikes or whatever the fuck, right? And all of a sudden, all those goods would be gone because everybody has the money to buy them. So they go and buy them. And all of a sudden, those goods are gone. And those producers, what do? They turn around and make some more, but they hike the price. Yeah, fuck yeah, because there's profit to be made. There's all this demand, right? And so they hike the price. And so what happens is that prices just start to rise and rise and rise in everything, okay? And so all of a sudden, the people want more money because now their dollar doesn't buy as much as it used to. And yeah, sure, it doesn't buy the iPods that they want or some shit like that, but also doesn't buy food or gasoline. You see? You see how it works? And so that's why they're not letting any of these free money schemes happen. I mean, all these free money schemes, I mean, they're the height of irresponsibility on the one hand. The stimulus checks, the student debt forgiveness, $15 minimum wage, fuck that. Fuck that shit. Fuck it in the ass as far as I'm concerned. That's just free money pandering bullshit, right? I mean, that's how these fucking Democrats won, by pandering. But, if they actually implement that shit, the dollar is going to crater in about 6 months tops, okay? And they know it. The financial authorities know it. And that's why all this talk about all these free money gimmies, right? It's just talk. It's just dying. And everybody's like, oh, Biden isn't living up to his promises. Fuck yeah. Come on. You can't be that fucking naive to think that he'd actually do it now, huh? Because the only solution to runaway inflation is extremely high interest rates. And extremely high interest rates would break the economy. It would cause a deflationary crash. See, remember, like I said at the beginning, every general fights his last war. And the financial authorities are terrified of a deflationary crash like in 2008. And therefore, they will not allow prices to collapse. They will try to inflate it. But inflation, once it gets going, once it really crosses a tipping point that nobody really knows, okay? It's just a moment when all of a sudden it just becomes a self-reinforcing cycle. The only way to stop it once it just really spirals out of control is to raise interest rates. Raise them not by a little, but by a lot. Paul Volcker, the chairman of the Federal Reserve back in 1980, he did it. And he had the balls to do it. I mean, it took incredible political courage. I mean, there were congressmen who wanted to kill him literally, who said, I want to kill you, okay, to his fucking face while he gave his congressional testimony. Look up Paul Volcker. He was this tall guy, bald, big glasses with a big cigar. He looked like the prototypical banker, right? But he was a man with balls. He stood up to the whole fucking country and raised interest rates until he finally stopped inflation. That's what had to be done, okay? The only solution to runaway inflation is extremely high interest rates. But in the current situation of the United States, if interest rates were raised dramatically to stop inflation, it would break everybody because people have become accustomed to extremely cheap money. If interest rates were adjusted, all these debts would go kaflooey. All these people who owe all this money would declare bankruptcy. I'm not talking just regular people. I'm talking about companies and banks. They'd all declare bankruptcy because they would not be able to pay the money that they owe. And so that's why interest rates, and that is why interest rates cannot be raised. They cannot be raised because everybody would go bankrupt. Everybody would suffer a 2008 crash, but like magnitudes bigger, like 10 times, 100 times bigger than 2008. And the financial authorities know that. So the authorities are hoping for a slow burning inflation that will be manageable, quote unquote. Manageable inflation. And you can see the fucking giant smirk on my face. Well, you can't see it, but assume it. I hope you can hear it in my voice at least. These fucking arrogant asshole prick fuckstick shithead cum-chugging faggots actually believe that they can control inflation and keep it at a slow roiling boil. They think that it's like cooking pasta or some shit like that. That they can fine-tune their way. They can manage the inflation. They're fucking morons. They're fucking morons because what happens is that once inflation gets going, see, there's this great metaphor. I don't know if it's a metaphor or an allegory. No, a metaphor. A great metaphor to understand inflation. Suppose you're at a stadium watching a football game, okay? And you're sitting there in the stands, and the guy in front of you stands up to get a better view, right? It doesn't matter why. Maybe there's like a food vendor in front of him or a guy with a really big head. Doesn't fucking matter. The guy right in front of you stands up to get a better view of the game. So what do? You stand up. I mean, you're behind him and a little bit higher up, but when you're sitting, he blocks your view. But if you stand up, your whole head is going to be higher than his, right? So you stand up. And what do the people behind you start to do? They stand up too, because you're blocking their view. And pretty soon the whole fucking stadium is on its feet, right? But then they're in the same position as they were before. And so what happens? Well, they look for something that they can stand on top of. And they stand on top of that. And everybody tries to do the same thing. And you see what happens. See? That's inflation. That's actually probably the best metaphor I ever heard for inflation because it's absolutely true. As prices rise for different goods and services, the people who are selling products that depend on these different goods and services, they raise their prices. And so it just becomes a spiral. Everybody's raising their prices. It becomes an inflationary death spiral. The only thing that can stop it is high interest rates. High interest rates stops high inflation. That's the only way. Paul Volcker proved that in 1979. The problem is that they can't do it today because the whole system is too indebted. It's too fragile. That's why they can't do it today. Back in 79, 80, they could do it because the system was a lot more robust. Now they cannot because everybody's too indebted. See? That's the problem. Okay? Now, what will this inflationary crash look like? Well, like everything, it'll be in stages. Now, these stages, of course, they're not going to have like bright dividing lines between them. Okay? You're going to have to pay attention to what the fuck is going on. But you'll notice certain things. Like first stage is there's going to be like slow moving inflation. Look at prices of food, gasoline, electricity, heating oil. That shit is going to rise. A friend of mine, I was talking to him yesterday, as a matter of fact, a guy in Chicago. He was telling me that he'd noticed that his food bill going up by quite a bit. And he's a single guy. And he's pretty regular in his habits, right? And what he does is that basically he has some service. I don't know if it's Amazon or some local supermarket or whatever the fuck. You know, he's got an online list. And he just sends the same fucking list every week or so. And he's noticed that the prices are going up. He's sending the same fucking list. So he's basically buying the same fucking basket of products. It's going up. And he noticed it. It was enough for him to notice. He guesstimated that it was something like between 5 and 10% month to month. And I was like, whoa, Nelly, 5 to 10% per month? That's a lot. No fucking kidding around. That's a lot. Huh? Look at your bills. Look at them carefully. Okay? And if you can somehow compare bills that have the same products from previous weeks or months and compare them to what you're paying today, do so. Check out the inflation that you're experiencing now, because that's where you're going to start to see it. In food, in gasoline, your heating bill, your electric bill. Maybe your entertainment, maybe not. I'm talking cable, Netflix, that kind of shit. But that kind of shit, it follows different patterns. It's a different beast altogether, so I'd ignore that. Food, gasoline, electricity, heating oil, those are commodity based. They're basically oil based. Okay. But see, the price of oil is not clearly indicative of inflation. Okay. It's the good or service that you're getting. That's indicative of inflation. Okay. The price of oil, the spot price of oil is not indicative of inflation because a lot of times the people who are buying the oil for different purposes, for the airlines, for truckers and whatnot, they've priced in the different valuations of oil and they've hedged their bets in the futures markets in order to have price stability for their industry. And so looking at the price of oil on the spot market, looking at, West Texas Intermediary or intermediate rather, or a Brent crude, it does not help you to figure out if there's inflation. Okay, lots of times the price of commodities fluctuates completely independent of inflation. So don't pay attention to that. Pay attention to what you're actually spending. Okay, that's the inflation that matters because it's the inflation that's coming out of your pocket. See what I'm saying? Okay, so the first stage is that you're going to see the slow-moving inflation in your food, gasoline, electric heating. Stage 2, and this is something I've noticed historically happens all over the goddamn place. Durable goods and used cars will start to flood the market, driving prices down for these things. And it's kind of weird. You're like, oh, what do you mean durable goods and cars? Yeah, like washing machines or jet skis. Like they're not like big ticket items like a house, but they're the toys, the accessories that you have, and they're going to start to flood the market. High-end cars, that happens a lot. High-end cars start flooding the market. And going at lower than expected prices or really low prices. You know what's going on? People are getting rid of their toys or what they think that they don't really need in order to get cash so that they can pay for their living expenses. That's what's going on. And that, you've turned a corner. And this has happened in every single country that has experienced an inflationary crash. Every single one. Look at the car market. Look at your local car market and the national car market. Used cars, of course. Okay? Notice the number of cars that are being sold. The number of cars being sold, is it increasing? And are the prices decreasing? Because, of course, if there's a lot more on offer, the prices naturally tend to go down. Yeah, because, I'm trying to sell a car, whatever car, I'm trying to get $10,000 for the fucking thing, right? And I see that I'm the only guy selling the car, so I figure, yeah, I'll get $10,000 for it, right? But I go on Craigslist or wherever the fuck to sell my car, and there are 20 other guys who are selling the same fucking car, even the same fucking color car, right? Same model year and, whatever. I'm going to say, fuck it. They're asking 10, I'll ask 9. I'll ask 8 because I need cash, and I'm going to sell this fucking thing, so I might as well just, sell it as quick as I can and, okay, bite the bullet and lose $2,000. So I can get this cash now. See? Because maybe that other guy lowers his price before I do. See? And if you don't lower your price, it's more likely than not that the other guy will see that you two are selling the same car as he is, and he will lower the price to $9,000 or $8,000 for the same fucking car. You see? Because, like I said, the metaphor of the stadium. When one person stands up, the people behind him stand up too. When everybody sees that everybody's trying to get rid of their car, they all lower their prices. Supply and demand, baby. That's how it works. Okay? So that's the second stage. Okay? The other thing you're going to see in the second stage is commodities and potentially energy prices are going to go up big time. And you're going to notice it. Okay? And commodities, I'm not talking about like gold and silver. Those are precious metals. I'm talking commodities like copper. Okay, aluminum, foods like soybeans and whatnot. Okay, corn, all these commodities, both industrial commodities and food commodities and energy prices, they go up. They go up big time, say 10, 15, 20% in a fairly brief amount of time, maybe a month or two. Yeah, you're in stage two. Okay. These are arbitrary stages, but just to keep you on track as to where you're going. Okay. Stage two, that's when you're going to see more and more people getting rid of shit on Craigslist in order to get cash because they need the cash for food, for energy. Yeah, that's what's going on. Okay. Stage three, middling stock prices start to collapse. Not the blue chips, not the ones at the top that have been around forever and can probably survive a bad period of time. No, I'm talking about the middling companies. The middling stock prices will collapse. The middling companies will go under because they're not going to be able to afford the high commodity prices. Okay? There's just not big enough to absorb big bumps in commodity prices. Hell, there might be some big companies that can't either. I'm thinking particularly airlines, okay? But airlines are incredibly weak right now because of COVID and no flying and no tourists and shit like that, right? But anyway, the middling companies, they start to fold because they can't keep up because it's too expensive and they don't have the customer base to make it happen. A lot of companies, middling companies that are consumer based, they start taking hits. They start taking hits, especially companies that sell items that are really discretionary spending. They take hits, they fold. Okay? You're going to see in the stock market a lot of these companies, these middling companies, folding, collapsing, their stocks going to zero. Okay? That's stage three. That's a bad sign. Okay? And then you're going to hit the moment when people start to exit the stock markets and the bond markets and try to acquire commodities as a hedge against inflation. See? I said before that the financial authorities, they want to avoid a deflationary crash at all costs, and they'll do whatever it takes, right? They do not want stock prices and bond prices to go down. They want to keep those prices up. They prefer to inflate the currency to give the illusion that those prices never went down, rather than watch as those prices do go down, nominally at least. Okay? I mean, this is their calculation. They're basically saying it's better to maintain the illusion of prices rather than see the reality of the price go down. You see? And so, ironically, what happens in an inflationary crash, when inflation starts to go up and up and up and up, people realize it. They're not stupid. And what they start doing is getting out of the stock market, out of the bond market, because they realize that these assets are essentially pegged to the value of the currency. And since the currency is losing value, those stocks, those bonds are losing value. So they're going to exit the currency and get into something that will maintain value over time. And what is that? Commodities. Not precious metals, notice, commodities. Aluminum, copper, oil, soybeans, whatever. You see? And thus, the stock market and the bond market crash when inflation really starts getting going. Okay? This historically happens every time. And what's interesting is that the financial authorities, they are thinking that they can avoid this. Like I said, they think that they can manage this inflation, that they can keep inflation at a slow boil, but never let it just splash all over the place. They think that they have what it takes to do that. They don't. Because everybody else who's ever tried to do the same fucking thing, insofar as financial authorities are concerned and inflation, they always fail. And they always say, this time is different. Or, it's not going to happen to me. I'm smarter than them. Every fucking time they say that fucking piece of shit. That's just arrogance. Yeah? You can't. And they're not going to be able to control it. So what's going to happen is that there's going to be even more inflation. Because what happens when everybody exits stocks and bonds and they all go into commodities? Because they're looking at commodities as a hedge for value. They're going to be exiting the dollar and getting into that commodity, oil, coal, whatever. And so that commodity, oil, coal, natural gas, soybeans, corn, well, it's going to rise in price, of course, now, won't it? Sure, it will. Because, see, if everybody's selling off their stocks to buy these commodities, agricultural commodities and industrial commodities, those commodity prices will rise. And, of course, that creates more inflation, see? Because in our society, in our industrial economy, we need these commodities. They are the building blocks for everything we got. We need the fucking oil for our cars to take us to places, and our trucks to bring us the food from the farm, right? We need the fucking soybean, to feed the cattle, right? And that we eat the meat from, right? We need all these commodities. And if everybody's exiting stocks, exiting bonds, and going to commodities, the commodity prices will naturally rise because there's greater demand for a limited supply, and that will pass on to you and me. We will pay more for food, more for gasoline. It'll just spiral out of control. And this is where we get to the inflationary death spiral. This is where inflation becomes a monster that cannot be stopped. It just goes up and up and up and up. And what happens is that, see, people start to think that prices are going to go up, and so they start trying to buy as quickly as possible. What happens in that situation? The shelves get emptied because people start buying. They start panic buying, like the stupid toilet thing. Remember this toilet thing back in March where every fucking moron wanted to buy toilet paper, of all things, I mean, Jesus. I mean, it would have made sense if it was, I don't know, anything else, but toilet paper? But anyway, every fucking moron went out there and cleaned out the toilet paper thing because they were scared, because they figured that there wasn't going to be any more toilet paper, okay? And you could say, yeah, they were dumb. Yeah, but fear is, panic. It's irrational. Mm-hmm. And so when people see that stuff is rising in price, essential products are rising in price, and there doesn't seem to be any end to it, what do? They take every last cent that they got and they go to the store and they buy every fucking thing that they see, even lots of things that they don't even need, because they'll figure, this is a store of value, because tomorrow it's going to be a lot more expensive. Just like the people exiting, the investors exiting the stock market and the bond market to go into the commodities market, people, the regular people on the street, they'll get their paycheck and they'll go straight to the supermarket and buy every fucking thing. They were not going to care what it is. They just want something solid, real, an actual commodity, fucking toothpaste, right? I mean, they'll buy dozens of tubes of toothpaste because they figure, I'm going to need it eventually, right? Maybe I can even fucking trade the fucking thing. And here, this is inflationary death spiral. And this happens in every society that has experienced this. In Chile, it happened. There were all kinds of stories. Yeah. And what happens to the financial authorities at this point? What? They're going to start not printing money, not giving price support? Because as they watch the stock market and the bond market start to collapse, right? What the fuck you think that they do? They let it collapse? No! Because of the reason that I explained before, they cannot allow the stock market and the bond market to collapse because of the collateral damage to the whole financial system. So when all these investors start to exit stocks and bonds and go into commodities in a big way, what happens? The financial authorities, the Federal Reserve, they print more money to give more price support to the stock and bond markets. Because for the reasons I mentioned before and explained before, they cannot allow the stock market and the bond market to collapse. And therefore, there is even more cash going to commodities. Yeah? The price of the stocks and bonds maintains, but all that extra cash goes to commodities, and it becomes even more expensive. And there's more cash, more bundles of cash. A bundle of $100, $10,000 in $100 bills, will not buy you a carton of cigarettes. That's how it's going to be if we go down an inflationary death spiral. And this is the mechanics of how it happens. See, As I explained at the beginning, see, all of this is very mechanistic. Everything is connected to everything else. All these gears, they're all connected. It's a clockwork. And you move one piece here and another piece over there pops up. And so this is how it's going to happen. And when we get to the inflationary death spiral, that's it. I mean, that's curtains, baby. The whole economy starts to collapse because what happens is, as prices rise, companies can no longer afford to pay for the commodities that they need to keep on going. And a lot of times, some of the workers are able to negotiate, and maybe they're unionized or whatnot and demand more money, but the company doesn't have the money, okay? Because the inflation is rising so fast that between the time that they produce the good and they sell it, they don't have any cash, any profit. So the rational thing for them to do is to shut down their factory, close shop, fire everybody, and just go bankrupt. And so what happens is that company, whatever doodad it was producing, whatever widget it had, it's no longer on the shelves. People can't buy it. And they're just stuck with cash, worthless bits of paper, and no goods. The goods are gone. And that's how it happens. That's how it fucking happens. That's an inflationary death spiral. The companies, they all start going broke. And see, we're already kind of that way because, see, this kind of progression of companies going broke, it starts with the little companies, i.e., the mom and pop stores, the little manufacturers, the little corner shop. And those got wiped out by COVID. Not by COVID, of course, but by the lockdowns, the stupid, irresponsible lockdown. And now because of that, you're going to have like the medium companies go bankrupt. They're going to naturally do that because it's not going to be worth it because the costs to them are too high. And they're going to have such huge costs and they're not going to be able to get the money back from sales. See? And so they go bankrupt and it goes up the food chain. And then bigger and bigger and bigger companies go bankrupt for the exact same reason until the whole economy crashes. And if you don't believe me, go to Venezuela. Because everything that I'm describing to you now, that's what happened in Venezuela. That's what's going on. Okay? Grim news, huh? Okay, let's go to the last slide. So, the only way to stop runaway inflation is to hike interest rates like in 1980, as I described before, Paul Volcker and the whole thing, right? But the financial authorities won't because they can't, because of the reasons I explained. The system is so over-indebted and so dependent on cheap money that an interest rate hike would bankrupt everyone. This is true. Individuals, corporations, state governments, federal governments, everybody would go tits up. The whole thing would just go out the window. So we're going to go through an inflationary death spiral. It's inevitable. They cannot stop it. It can't be stopped, and the financial authorities will come to believe that they can control it, but they can't. And it'll just go bigger and bigger and bigger and bigger and just eat up the whole fucking economy until the whole fucking place is bankrupt. And we're all walking around with these wheelbarrows full of cash. That is going to happen. That's the end game of this whole situation, okay? Now, if this were to happen in the United States, and by the way, a fair question, do I think that this will happen? Dude, anything can happen at this point. I mean, anything can happen. The crazy shit that's happened over the last 18 months, anything can happen as far as I'm concerned. So you tell me that in 18 months, we somehow, it all got better and we're all saved, or in 18 months, we're all like, the entire financial system has crashed, the dollar hyperinflated by 20,000 billion %, and we're all walking around with clubs beating each other over food. I wouldn't be surprised by that either, okay? Anything can happen. But realistically, do I think it's going to be a happy ending? Do I think that, in, July, August of 2022, things are going to be hunky-dory? Fuck no. It's going to be a fucking disaster, okay? And I think that we are going to experience an inflationary death spiral. Okay? It can't be stopped. That's my thinking. So how does it end? Well, it ends with the collapse and rebuild of the entire financial system. That's how it ends, because that's how it's always ended. Okay? In Chile in 73, there was like 100% inflation per month. Okay? That is, the money that you had at the beginning of the month was worth half that by the end of the month. Okay? So the whole thing, when the coup d'etat happened in 73 and they threw those fucking communists, right? And Pinochet took over and installed like some sensible fucking people who knew more or less what the fuck they were doing, the Chicago boys. And, the whole thing, they had to just restructure the whole fucking thing. People got wiped out, pension funds just out the window. They even implemented a new currency. The old currency was the escudo. They threw that out and they brought in the peso. Yeah, they're going to have to do that. That's how it's going to happen, if the dollar goes into an inflationary death spiral, they're going to come up with a new dollar or something, or maybe they'll call it the American. The American has like a nice ring to it, The new dollar seems sketchy, but the American, that sounds pretty cool, Yeah, they'll come up with a new currency. Yeah, all you have to do is like look at countries that have gone through an inflationary death spiral. At the end, every sector of the economy is affected and crippled. At the end, manufacturing, value-added businesses are destroyed. Okay? The only thing that kind of like survives are commodity-based industries. See? Because commodities are real. They're something real. Okay? Now, how do you protect your net worth from an inflationary crash and death spiral? You buy something that will retain value over time, regardless of market conditions. Okay? The obvious thing is precious metals and land, not cryptos. Okay? For the reasons I explained before, cryptos are just a mirage, man. Okay? And yeah, a lot of fucking people made a lot of fucking money off of cryptos. It still doesn't change the fact that they're fucking mirages. Okay? There's nothing there. It's not real. Okay? And people say that, it's valuable because it's limited, and yeah, but still it's bullshit because you don't need it. Okay? And look, at the end of the day, if you're like a crypto weenie who does not believe me, nothing I say will convince you otherwise. Okay? The only thing that will convince you otherwise is experience. In 2 years, 5 years, let's see who's doing okay. If Bitcoin in 5 years is worth, I don't know, $500,000 or worth nothing. And everybody's like, what the fuck were we thinking when we were buying that shit? Like the Dutch thought after tulip mania finally ended and they realized that they were betting houses over flowers because that's what they were doing. Okay? Tulip mania, study that fucking thing. That was fucking funny on the one hand, but kind of tragic at the same time. But anyway, precious metals and land, that's the only thing that will retain value. Commodities, generally speaking. But here's the problem that we're having with precious metals. See, the gold market is exceedingly small, okay? People don't realize how small it is, okay? It's only something like, it's less than 100 billion, okay? I think it's like 85 billion, okay? That's the total gold market. That is, every bit of gold on the face of the planet added up is about $85 billion, which is not a hell of a lot of money, okay? It sounds like a lot, yeah? But, Google is worth 10 times that, more than 10 times that, actually close to 20 times that, okay? And Google is a company that actually makes money. I mean, for hell, Apple has in cash right now more money than that, okay? More money than the entire gold market. So, because it's such a small market, it's easy to manipulate. It's exceedingly easy to manipulate. And my suspicion is that there's a department at the Federal Reserve that's goal is to manipulate the price of gold. Hell, there was a big lawsuit a while back about, gold pricing at the London Exchange. I forget the details of it, right? But there were like indictments and the whole thing. Some people got into a lot of trouble over that shit, right? But that goes to prove you that, just a few random guys can hack the gold market because it's fucking small. Okay? That's the problem with gold. It's a small market, easily hackable. Okay? And so uh, um, gold is not something I would, I don't have any gold, by the way. Silver, on the other hand, now we're talking. Silver is a lot larger market. It's actually used in industrial processes. Okay, so is platinum, but platinum is very dependent on the car industry because platinum is used in catalytic converters. And so when the car market is doing poorly, platinum does very poorly. Okay, and so it's really dependent on the car industry, and it's not so much a store of value, but silver is, because even though it's a precious metal and also an industrial metal, its industrial usage is a lot more stable and widespread. It's used in a whole host of different things. And therefore, that's why silver is a better precious metal. And silver has been doing very interesting things as of late. Okay. So, silver, yeah. The other thing, of course, is land, because land never disappears. The issue, of course, becomes, will the land become more valuable, i.e., will it produce a revenue into the future? Because when we talk about land, we're not talking about raw land. We're talking about houses or buildings, offices, retail spaces, apartment buildings, right? And because of COVID and because of our communications technology, all of a sudden, the old truisms about land and real estate are kind of like out the window. Because people used to think that, oh, you have to, get stuff in like the downtown area and in the good neighborhoods. But with remote working, people can work in all kinds of obscure places. And so paradoxically, there's no clearly safe place to invest insofar as land and real estate. And also because of COVID and the growth of online shopping, retail is also extremely vulnerable. I actually am slightly exposed to retail, and yeah, I'm seeing it, and I'm not a happy camper. It's I have exposure to retail and office, about 15% of my net worth, and I am not a happy camper. Yeah, because those positions that I've had them for a long time. Yeah, they're just not producing because the tenants there, they had to split because COVID, right? And it's not looking like I'll be able to get any more tenants for those properties. It could be that 15% of my net worth, it's a loss. Okay. Well, part of that is like an office in a place that it's always going to be, used. So I'm not worried about that. But the retail space, yeah, I'm thinking that's going to be a net loss. Okay. And it's a fairly, nice one in a nice place, but COVID, man. So anyway. But I'm just bringing this up to emphasize the fact that we are in uncharted territory. Okay, we really are in uncharted territory, and so the smart thing is just to keep your eyes open and be monitoring everything. Okay, and understand more or less the shape of what's happening. Okay, because if you don't, or let me phrase this. There is no way to predict what's going to happen. What I've been discussing here is a guideline as to how an inflationary crash might happen and the effects of it and the development of it. But nobody can predict anything. And so it's good to think of all this stuff, but not look at it like a map or a guidebook that is inflexibly correct. Okay? Okay. Now, how do you take advantage of an inflationary crash? Well, think of it. What happens in inflation? The currency goes down in value, right? So if somebody owes me money, okay, think of it in these terms. Somebody owes me money. Somebody owes you money, right? They owe me, just say for the sake of argument, $100,000. And there's 20% inflation. Well, all of a sudden that $100,000, yeah, nominally it's $100,000, but in terms of buying power, it's gone down. It's $80,000, right? So you see, you start to see the point. Whoever has debts, inflation is good for them because the nominal value, that is the value that's printed on the documents, it stays the same. Yeah, the price does not fall. But in buying power, it does. In actual value, it does. So the smart thing is to go into debt at fixed rates that cannot be adjusted for inflation. You do that, which I have actually done. And I made it a point to make sure that in the mortgage contracts that I signed, because I've gone into certain real estate positions, right? And I took out mortgages in order to get into them. And those mortgages, I saw to it and had my lawyers just like look through every little nook and cranny of those contracts to make sure that there is no way for them to adjust the payment in the case of inflation. It's fixed. Fixed. And I actually had to pay a little bit extra insofar as interest. I didn't mind. I wanted that fucker pegged down. If there's inflation up the wazoo, my payments do not change, which is exactly what I want. See? Because if there's inflation, yeah, I mean, think of it in these terms. You owe $100,000, say, and inflation goes up like catastrophically, and all of a sudden, you need $10,000 to buy a carton of cigarettes, right? Well, what would that mean for that $100,000 debt that I have? It's just 10 cartons of cigarettes, right? Yeah, because, if one carton of cigarettes, because of this dollar hyperinflation, is $10,000, well, then 10 cartons of cigarettes is $100,000, right? Yeah. I get paid off with 10 cartons of cigarettes, which is, very little. It doesn't cost a lot. See, that's the point. If you think that there's going to be inflation, now is the time to get into debt at fixed interest rates that are non-adjustable and that cannot be adjusted for inflation or are not adjusted by any inflation index, CPI or any shit like that. And that's what you do. That's what I'm doing. I'm not giving financial advice. Okay? I am not giving financial advice under any stretch of the imagination. I'm just telling you what I am doing. See? Buy shit that you know that inflation will eat the debt away for you. See? And the other thing, too, is to have things, objects, assets that you can swap. I've told this story many times before of an uncle of mine who was studying architecture in 1973. He was a college student, and he had a piece of shit Fiat 125. Look it up. It's just a piece of shit, right? He had a 125 Fiat, and some people in Chile were so desperate that they were willing to give him a luxury apartment for his car, okay? Because the car had more value, and they also wanted to get the fuck out of Chile, and so they were willing to swap the apartment for a car. And the car is long gone, but the apartment's still around. My uncle didn't take them up on the offer, and it's the one regret he had for the rest of his life. He kept on talking about it so many times that the story stuck with me, and I've told it a bunch of times. But it's incredibly illuminating and evocative, and it shocks you. It shocks you to realize that the financial situation can so collapse that people are willing to swap a luxury apartment for a fucking car, and a crappy car at that. Yeah? And like I said, the apartment is still around, and it's still in a very nice area, in a very nice building. Well, it's not so nice now, but that's neither here nor there. But the car is long gone. It's in some landfill, who knows where. Yeah? Yeah. But the apartment is still there. It's still a luxury building. It's a luxury apartment. Really, really nice. See? That's the kind of opportunities you can have. See? Never be afraid of change. Never be afraid of chaos. In chaos is opportunity. Yeah. Now, the final question. Do I think that this inflationary death spiral will happen? Yes. I've been thinking about it for a long time. I thought it was going to happen a lot sooner, but it didn't. They were able to squeak by. I thought that this shit was going to happen like in 2012, okay? I've been talking about it and thinking about it since 2010. And it's not that, I'm like a perennial, I'm starting to realize that what happens to me is that I tend to see what's going to happen long before it hits. In 1999, I saw that the housing market was in a crash. I thought it was insane. And it took 9 years for it to crash. In 1999, living in New York City, I had the opportunity to buy property in New York City, and I didn't take it because I thought, man, these valuations are insane, and the whole property market is just insane. The whole fucking thing is going to blow up. And like I said, it took 9 years. In 2010, I thought, this QE and all the shit that they're pulling, pumping all this money into the system, it's going to end up in inflation, man. It's inevitable. And here we are. 10 years, 11 years later, still hasn't happened. Do I think it'll happen? Yeah, because I know it's going to rain. I don't know when it's going to rain, but I know it's going to rain. They keep doing the shit that they've been doing of pumping all this money into the system. It's inevitable. Inevitable. Mm-hmm. But the problem is when. When. And so that's why I put those stages for you so that you can see when it's going to happen. See, those are the markers that's happening. Okay? And when we're really in the grips of it, you'll know. Everybody's going to be talking about it. It's not going to be like a big surprise. Okay? I mean, you'll know. Yeah. And you're going to see how assets start to slide in price. Stocks and bonds start to slide in price. And the Federal Reserve comes in and becomes the buyer of last resort, pumps a shit ton of money back into the market to prop everything up. And that just makes the problem worse. Because these fuckers think that they think that they know better. That's the problem. It's that arrogance, that lack of humility. Okay? You always have to be humble. Mm-hmm. So anyway, here I'm going to come to the end of this webinar. It's been a little bit shorter than usual, but the subject matter is a little bit more snowy. So yeah, I'm figuring that a lot of you have big heads and you're probably exhausted of my voice. I certainly am. But anyway, next week I'm going to be discussing, it's my birthday, by the way, next week, next weekend rather. I was born February 29th, 1968. And this year there's no leap year. So on February 28th, which is the last day of February, the last Sunday of February, I'm posting a webinar number 48, which I'm going to be discussing my favorite band, Rush, because I figured for my birthday webinar, I can discuss whatever the fuck I want. And that's what I want to talk about. And so I hope you join me then. I hope you've enjoyed this webinar. And a final note, about all this doom and gloom shit. Okay? See, yeah, I'm saying that it's all going to be doom and gloom and it's going to be fucking horrible and blah, blah, blah. But, you gotta take it with a little bit of humor and realize that, see, life is long. And there are going to be all kinds of crises and crashes and whatnot in your lifetime. And so you just have to experience it like a roller coaster and understand that fundamentally it's just fucking money. It comes, it goes, If you lose your shirt, everything goes tits up in your life, financially speaking, during this crash, don't worry about it. It'll come back around. It always does. I'm going to turn 53 years old, and I have been poor and rich multiple times, okay? It wasn't that I was poor one time and then I became rich and, happy sailings. No. I was like poor and then rich and then poor and then rich and then poor again and then rich, It's up and down. And what happens is that as you go through life and you have these ups and downs, you realize that, number one, you don't need that much to be happy, number one, which is the most important thing. And number two, you realize how funny it is. You realize how funny how the money comes and goes and everybody freaks out. And in a very real sense, there isn't a hell of a lot that you can do. Okay? Not because the powers that be control everything or there's some cabal running everything. No. Because even these fucking people, they don't control shit. They think that they do, but they don't. Mm-hmm. So much of what's going on is just chance and very bad decisions, a lot of arrogance and stupidity, but mostly chance. There are guys who are way smarter than me, who have spent their entire lives trying to figure out how to make a shit ton of money, and they've never succeeded. In my own case, several times I literally backed my ass into fortunes by pure luck, okay? Last year, as a matter of fact, last March, I made a shit ton of fucking money by pure chance. I mean, I wish I could say it was because I was so fucking smart. I wasn't. I just, I was just like blindly backing my ass and wound up sitting on a pot of gold. True story. Okay. I don't want to discuss it because it's personal on the one hand, it's boring, and I don't want to like crow on it because there's nothing to crow about it. It was luck. And the older I get, the more I realize that a lot of it is just luck. Okay. Investing is luck. Okay. So take it with a sense of humor. Enjoy the show. That's my bottom line suggestion. Because, yeah, I think that this whole thing is going to go tits up. It's going to be fucking funny. And so just enjoy the show. Okay? Okay. I hope I've put you in the right mind frame for what's about to come. So thank you so much for listening, and I will catch you next time.